Are you on the lookout for your next investment property? Smart Property Investment and Pure Property Investment have done the research for you on where the hottest up-and-coming suburbs for 2024 are and where you should invest for the best return. The report is completely free to download. Visit smartpropertyinvestment.com.au. Don't make any moves until you've read the report. Take your next step with all the facts, backed by research and industry experts.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here, host of the Smart Property Investment Show. Hope you're well. I'm joined by a real estate celebrity today, Arjun Paliwal. He's the head of CEO of InvestorKit. And if you weren't there, and I know most of you weren't because some people were, some people weren't, only recently his business, InvestorKit, won the Buyer's Agency of the Year at the 2023 REB Awards, which is a big awards program for Australia's real estate sector. He's joining him in the studio. I'm a bit nervous. Don't know what I need to say. Arjun, how you going? You well?
Mate, I don't think the celeb effect is there to create nervousness just yet, mate. But I appreciate it.
Yeah, that's pretty cool. I saw you down at the function, REB Awards. I think it's in its 11th year, and this is the independent program for Australia's real estate agents. So we have a lot of property investors tuning in this, and they're probably saying, so what? Well, I'm happy to report to property investors that there is this mechanism for measuring success in real estate. And it's the REB Awards that awards the whole sector, ranging from sales agent and property managers all the way through to buyers agencies and buyers agents. And I've been banging on for it for a number of years now about how I feel the buyers agent sector is only its infancy in Australia. It's very nascent, and it's a long, long way to go. So to be able to measure success in buyers agencies and buyers agents at such a formative time of its industry development, it's great to see. And Arjun, you must be proud, mate. How'd you celebrate with your team on the night?
We just continued to charge on. It was one of those nights where my typical bedtime up until that night was about 10 or 11. And that was one of those where we went into it in the next morning. So we celebrated for sure. Did
you stay? It was at the Star City Casino in Sydney. Did you kick on in the sports bar or something or other?
Yeah, pretty much that. And we actually got to catch up with a few others, obviously, in the industry from both buyer's side, seller's side, property managers, as you pointed out. It was a good night.
What I noticed, Arjun, I have a lot of visibility. I orientate myself around a whole bunch of industry sectors, right? Real estate sector is fierce competition, particularly at the sales agent and the property management level. I say mainly at the sales agent level. It's fiercely competitive because everyone's competing within their own region and there's their own locale for the same listings, right? Hyper competitive. But I do note though that the buyers agent sector, buyers agents, it's pretty collegiate. You all seem to get on a lot better than real estate agents. What do you think that's the case?
I think it partly has to do with the fact that you're not working with the client to get rid of something for them, you're probably acquiring. And so when all the moments are to do with acquiring, building, growth, just because you live and breathe that with clients, I think it just starts to spill over to the rest of the industry. That's one component. But the second component is it's just started in a new era. I'm not saying that there weren't buyers agents in the 90s and 80s, but I just feel like there isn't any baggage left over in the industry for many decades. It's kind of something new and it's picking up. And that's
I think it's collegiate because I sort of know all the best buyers agents in Australia and they're all quite friendly to me. But I do notice though buyers agents talking to each other and sharing notes. And yes, they do often compete for the same properties in certain locations. But by and large, I think there's this wholesome universal appreciation for the upside for the buyers agent sector and the fact that it's not about competing against each other, it's growing the sector. It's making it bigger. So there's enough business out there for everyone. And here at Smart Property Investment, we've been doing our bit to make sure we socialise the very important work of buyers agents. So what's next for InvestorKit then, Arjun? Buyers Agency of the Year 2023. It's a big milestone, mate.
It's really special, and I think reflecting on last year helps us kind of understand what's next in terms of that greater vision. But looking at last year, one of the biggest things that I feel contributed towards the growth outside of our great team and outside of the relationships and obviously servicing clients well was the strategy to do with, we are going to interpret and share research better than ever and more helpful than ever. And that was a very important point, because there's this world of business that quickly becomes putting out content because you have to put content, right? And then putting out supportive info because it's just a way that you think works to get X. That is something that we cut going back a few years ago to go, hey, this is going to come out because it helps someone achieve Y, achieve X. And it was very intent around unlocking information that's a little bit more hidden or difficult and just making it out there. So us is a matter of just growing on that now and just going, hey, how can we take the insights, the research, and build with all this technology that's coming out and really incorporate that to make results better, information better, and get people making smarter decisions. That's probably the most important one. But in terms of the actual growth of the team, that's been the second one, to not only grow in the world of agents, but continue the model that's been grow in support and agents. And that's something that's quite unique, because what happens is that many people will grow agent after agent in the team and have a large agency of agents. But one thing that we did differently was growing a whole bunch of support so that the agent can do what the agent needs to do best, which is look after a client, meet their goals, and have all the back end looked after. And that's been something that from our growth of our team, our clients have appreciated, because they can feel like they've still got that small business day one experience, even if they're the 30th person that came on board to work with us. And that's kind of what we want to make sure we continue as we grow and build a business.
So no doubt the judges for the REB Awards sort of recognise the rapid growth in team numbers, but I think and I'm not across exactly your submissions or what the judges saw. However, I would imagine that the fact that you a lot of the work that you do is underpinned by the sharing of data, the interpretation, analysis of data, and the sharing that information. I know you have the Property Nerds podcast, which is syndicated on the Property Investment Podcast Network, where most people are tuning into this podcast now. You also have your own Investigate podcast, but you've been vocal, very active and vocal. You're not keeping the crown jewel secret, right? You're happy to share it and be an advocate for data-driven property analysis, and no doubt that's probably resonated with the judges.
Yeah, I think that's a key part. We realized very quickly that we're living in an information heavy and friendly and, AI, all the things that you want to put out there. The world, our customers, everyone is getting smarter. And that's a good thing, because all it means now is that they are very, very aware that I need help because I'm time poor, or I need help because I want the people who interpret this regularly and to a certain level of quality. And so what that meant for us is that, hey, it's not about the secrets to my chest or this location or that. People know everything now. It's not about that. It's more about, I will deliver the best service I can for you to help you hit your goals. I will ensure that because you're time poor, we need to do this. And I will ensure that I spend all the time, energy, resources, my team to interpret it better than anyone else, because you trust us to make such a big financial decision. So that was the big turning point. And I'm very grateful that obviously judges saw that. And yeah, that's where we are today.
And you're well known and regarded for, your role, head of research within your business and forecasting the market. And often you have a contrarian view to other people, which is data-led and data-driven. So I want to sort of drill into that. We'll just go to a quick break. Stay with us, everyone. Back in a moment.
Are you feeling the strain of high mortgage repayments? Refinancing with Finny Mortgages can help you save big on your home loan and ease the burden on your finances. Our team of expert brokers specialises in helping Australian investors find the best possible rates. Refinance with Finny Mortgages today and start saving. Visit finny.com.au or call us now at 028 866 2444 to chat with an expert.
Welcome back. It's Phil Tarrant, host of the Smart Property Investment Show, with Arjun Paliwal from Investigate. Now, Arjun, you were, I remember having a yarn with you about this some time ago, but you've also been posting quite a lot about it. You were one of the sort of first to call a clear housing recovery in the national data sets for 2023, that was back sort of late-ish 2022. And this was a point in time when interest rates were still going up, driving forward. The price declines, so everyone was sort of seeing their properties go down in value. Sentiment was really, really low at that point in time. People were like putting their heads in their hands going, property is a bad asset because it's going down in value rapidly. And at the point in time when borrowing capabilities were starting to squeeze a lot of people, where serviceability was pricing them out of certain properties, or if not, stopping them from investing altogether. So you come out and went, nah, it's north from here, and that was based on national data sets. So we've got to be careful to deconstruct or disconnect national data sets, as in the property market that everyone talks about, versus what's happening at a localized level, because there's an argument, and you've posed, or your thesis would be, there is no such thing as a property recovery because it never ever really needed to recover, because a lot of markets were still performing really, really well. However, at an aggregate level with national data sets, because of the way in which it's sliced and diced and the weight of where assets are in Sydney and Melbourne, go the perception that holistically property markets were in decline. So it's very, very complicated. But you called it back in late 2022 that the only way is up. You still subscribe to that?
Yeah, actually, I can recall this late last year. I think Kyle Robbins was one of the journalists in the team.
That's right.
The Smart Property Investment shared the article where I'd shared thoughts around, hey, 2023 will be a recovery and we can expect it pretty early. And I think the biggest difference in my analysis, Phil, was that the expectation of the recovery wasn't to do with because interest rates will do X. And this is the one thing many people have made mistakes on when analyzing, including economists, banks, everyone almost. And the biggest thing was, one thing, population growth shuts off, the whole country should see housing decline because of COVID. Or population's back, and the people who are quiet when population shut off now are saying population's back, therefore everything should come back now.
It's very myopic, right?
That's it. And so as a result, the key was, no, we need to take a step back and actually plug the pieces together and join the dots. And I guess if I was to run down a few of the reasons that I felt comfortable in making that call last year, was to begin with the component of supply. Supply doesn't lie. Is one thing I've been very, very vocal about, because demand, one person thinks X does that, being the infrastructure project. One person thinks people coming in. One person thinks interest rates. Supply is just no bullcrap there. It is houses for sale are here or they're up here. Properties for rent are here or there's up there. And so when we were looking at supply, Phil, the first point I picked up was that listings for sale late last year, October data, our friends at SQM Research said that essentially we had the same listing levels for sale nationally as we did going back to March of 2010. Now, we had 4 million less people back then. So there's a greater marketplace, 4 million more people operating with the same number of houses from when we had less 4 million people. So that was the first thing that just said, hold on a minute, this isn't coming together. This can't be around for long because there's nothing there for sale. And then that moved on to the second part, which is rate rises happen pretty quickly and aggressively, and as did price declines. And it was fair to say that was a majority, because if it wasn't a majority, then we're all in for some pretty troubled times. Like if what we've seen so far wasn't the majority of rate rises, then we're all going to have it very tough. And so I think from that perspective, that was something just from assessment rates, what banks felt comfortable, what Australia had been stress tested at. To me, I was thinking, hey, surely this isn't just a quarter of the way there. This is probably 2/3 to 3/4 of the way there. And then if you compound that with a few other things like policy changes in stamp duty, obviously that's not going to last long because the Libs are no longer here. But that was a huge shift. Stamp duty, land tax, 1.5 million. Finally, someone spoke some common sense of the price range in our biggest cities that represent such large transactions. Whereas unfortunately now, Phil, the Labor coming in has actually immediately stripped that back down post new financial year, down to 1 million discounted land tax and 800 waived, stamp duty, not land tax. And so that's a big shift. That's $500,000 of purchasing power where someone had a choice immediately eroded in places like Sydney. But that did make a positive impact at the start of this year. And then when you combine it with other reasons like rental crisis is still in play, migration growing heavily, people seeing double-digit rental increases. You'd be surprised at how many people like, oh, I'm sick of renting, I'm sick of this. And then even without doing the numbers to buy a home, they're already making this mental decision like, I want to go and buy a home. Funnily enough, when you actually do the numbers in places like Sydney, the rents, even after such a big jump, are still cheaper to rent than it is to buy for most properties. But these are just some of the reasons, Phil, of last year and reflecting on it. And I think obviously some of the reasons ahead to add to that picture is that historical lengths of downturns typically aren't that long. And finally, looking at some of the regulatory environments right now, we've already started seeing a couple of small lenders shift their assessment rates, which in simple terms, for those new to assessment rates, is how much percent of lending the banks are assessing you on your interest rates above what the rates are today, just to be conservative so you don't fall behind and stuff. And our predictions were that they would reduce those. Some small banks have already started reducing those. So it'll be interesting to see if APRA and regulation discussions with the bigger banks start to happen too.
Yeah, I don't know what's going to happen there, because the obvious thing to do is to remove those buffers that you're talking about, and they jacked them up when interest rates were at all-time lows of 0.1% to 3% buffer. So, you know, if your mortgage rate was 4%, they were assessing it as though it was 7%. Now, most people are now paying variable interest rates as investors in the high 5s, 6s, maybe up into the 7s, right? So that's that buffer coming into effect there. So they're still assessing people with that 3% buffer. So you're getting assessed at somewhere probably between 10 and 11%, I would say, Arjun. There's an argument to say it shouldn't be that high, but you know, the mail that I have is that APRA is like, no, we're not changing this. So expect this for some time. Now, that's a prudential regulator, so that's obviously focused at the major lending institutions. From what I understand, Arjun, it doesn't apply to smaller lenders, right, or non-bank lenders who get their money through warehouse facilities or elsewhere. So they set their own rules. So that's a good mechanism of choice for people who are struggling to secure finance. They can go to second-tier lenders, non-major lenders, non-bank lenders, and secure finance. But there's a good reason why they put those buffers in place, is so when you get to a point when interest rates go up, most people was assessed on the basis that that was going to happen. The issue you've got, though, is that a lot of people might not have go over a full picture of their financial capability to repay loans at that point in time at that assessment. So this is a very important role that a mortgage broker has to play to make sure that you're getting assessed at the right level and you can afford to take on debt. But your argument then, Arjun, is that at a national level, property started recovering in late 2022.
Yeah, I mean, late 22 heading to 2023, sorry. The start of this year was definitely that recovery, and it was just all those factors coming together. There wasn't this one thing. It was undersupply for sale, undersupply for rent, the majority of declines and rate rises behind us, policy changes, migration, value in the eyes of buyers, like something as simple as just people thinking, hey, it's cheaper than last year. And then combining that with some potential things ahead, which is the length of downturns not that long, regulatory changes, and just the forces at play continuing on, I guess.
So if there's a national recovery underway, that doesn't say all markets are still increasing, right? And this is where a lot of people get it wrong, because I want to chat about the other side of the ledger and in a moment, which is the fact that some locations have performed well, even though there's been a national downturn at a micro regional level, suburb location level. There's been a lot of very well performing stuff. But just because someone says things have changed, that doesn't mean everywhere is going to change at the same speed in terms of from negative growth to positive growth. And you know, Sydney gets all the headlines, and I think for the last couple of months, Sydney's been in positive territory. I don't know how April ended up, but I know sort of Jan, Feb, March were positive in terms of growth. So it wasn't going backwards. It's abated and now starting to go in the other direction. But you know, Sydney dominates Australian property. But just because the Sydney cycle's changed doesn't mean Melbourne's changed. What's your views there?
Yeah, you've touched on the most important part of property data when you get micro, and that is something that's often ignored when the national data sets come into play, and that is what we call statistical weighting. So if we just talk about the three major cities, right, of our country, they host half the country's population. It's essentially 49.8%, if you want to be precise. They also host 43% of the country's housing stock. And so when their values rise or decline, that is shifting a lot and therefore creates a national trend. And so this is where I've done this analysis both at COVID time as well as, again, in the next milestone, which has been the interest rates shifting. And I want to throw up some pretty interesting numbers. So we use this definition of an area called SA3. And for just simplification, let's just call SA3 as a council or similar to it, because they're essentially a cluster that ABS uses for data to put a whole bunch of suburbs together, just to make it a little bit more reliable. So you aren't relying on the suburb of 5,000 people and saying, oh, I see a boom here. And so essentially what we found is I'll give you the most extreme examples being Sydney, Melbourne, and then I'll give you the opposite examples in, say, South Australia. So Sydney had 96%, they had 47 SA3s, of which 45 declined in 2022. Okay. So huge numbers. Melbourne had 90% of the 40 SA3s, 36 declined, and then Brisbane had 39 SA3s and 31 declined. So just taking those three at 96, 90, and 79, and we know now that they represent half the country's housing data, bam, there you have it. Mistakes everywhere of interpretation of data because they think something's falling when, like you said, Phil, the opposite may be happening in some areas. So where were those opposites happening? Regional South Australia, 9 SA3s, only 1 was declining in 22. That represents 11%. Greater Adelaide, 19 SA3s and only 5 were declining, which represents 26%. I'll give you Perth as well. 21 SA3s, 8 were declining, 38%, so far lower than the Brizzy, Sydney, Melbourne. And then one more to throw in there as well is regional Queensland, which is another star alongside regional Vic, but regional Queensland, 43 SA3s, 23 declined, 53%. So looking at that data, you had a 9 in 10 chance to buy in a declining market last year in Sydney, Melbourne, and then about an 8 in 10 chance to buy in a declining market last year in Brisbane. But your chances of declining in Adelaide were 1 in 4, or in regional SA, 1 in 10, and in regional Queensland, regional Vic, 1 in 2. So if you suddenly take these numbers and apply this not just to last year, but literally you can apply this data every year, there will be counts of years where we have what's called our national boom and national decline. And those are greater proportions of those numbers swinging in a certain way. But there will always be something somewhere where you can be confident that it's likely to rise in value that given year, right? So that's kind of what I picked up.
Yeah. How many of those nationally are those sort of groupings? There's about a few thousand.
330 SA3s.
There's 330 SA3s. So what was for the last 12 months of those 330 SA3s, how many were going backwards versus how many were going forwards? What was the washout?
Yeah. So we had, in terms of the 330, we had 212 that were either peaked or declining. 58 had stabilized and flattened. Yep. 64 were increasing.
Okay, so sort of a quarter were increasing, a quarter, very general, were stabilizing, and half. So essentially, if you're investing in property, there's a 50% chance you're investing somewhere that was going backwards. There was a Correct. 25% chance you were investing in something which wasn't going to move at all or wasn't moving, and then there's a 25% chance that you're going to invest in somewhere where you're going to see positive growth.
Yeah, 60-20-20 to be precise.
Okay, so there you go. Yeah.
20-20, right? And so when you have half the country representing, half the country's data represented by 3 cities, there's no way that you can obviously look at national data and make a fair call. And this is just the thing that we see every year. Even when times are good, they're not that good everywhere. And so that's the thing. When we go back to our COVID boom, we had the highest proportion of SA3s increasing. But even in those increases, there was some areas that were late to the party. Like let's take regional Queensland was late to the party. We had very few of them, regional Queensland, far north and central, increasing by double digits during that time. Whereas Sydney was flying off the shelf, Melbourne was flying well, Brisbane, Adelaide was a superstar, all these other areas. But then now, all of a sudden, regional Queensland, regional SA, Adelaide, Perth, these are the superstar markets based on the opposite, even when times are declining. So it's a great point to look at.
And this goes back to the point that you made around being data-driven, because, there's this intersection between how data plays out in the real world. And I received a note from you yesterday, pretty much, is the Australian property downturn over? And that's sort of what we're chatting to. Let's just dig in a little bit more. We'll just go to another break. Stay with us. Back in a moment.
Have you been thinking about diversifying your property portfolio, but unsure how or where to invest next? SJR Property Group is a buyer's agency based in Perth, specialising in helping East Coast investors diversify their portfolios. We focus on helping our clients achieve their financial goals by investing in high-quality, high-cash-flow investment properties that are poised for long-term capital growth. If you've been thinking of investing in the WA market, the team at SJR have feet on the ground and are here to help. Visit sjrpropertygroup.com.au or call us today on 1300 757 774 to chat with an expert.
And welcome back, Phil Tarrant from Smart Property Investment with Arjun Paliwal. Now, Arjun, so you're seeing Australia's housing market rise in value for the last couple of months, and everyone's sort of saying, hey, the downturn's over. People I sort of follow are now starting to say that this last interest rate rise is starting to have a bit of an impact, and whether that's going to start shaping supply, because, that might be the accelerator for people to start doing distressed selling. I don't know if you've got a view on that at all.
Yeah, good question. So it would be silly for anyone to believe that it's not making an impact. Absolutely silly. There are, yes, some strengths and some green shoots that we're seeing, but if this madness of rate increases doesn't stop now, it does get worse month on month. No matter how many well-employed people we have, no matter how many migrants coming in, bringing in cash, no matter how many jobs are out there, those are great fundamentals holistically when looking at housing. But they can quickly change if we don't know when to put our foot off the brakes. And I'm referring to the RBA interest rates.
Yeah.
So there's already been some upticks, Phil, in what we call delinquency rates. And those delinquency rates are essentially tracking people where mortgages are not paid after 30 days or certain, arrears showing up. And those upticks right now are more prominent in our smaller lenders who are obviously willing to give a little bit more lending away when borrowing capacity is tough. But they are still at low bases. So the good news is, as in Australia, we're still healthy. But that chart, as a data-driven individual, I'm seeing these charts, it's like climbing Mount Everest. They're picking up pretty quickly, right? They're looking high, very, very big curves. So if we just keep pressing on that harder and harder, then naturally more people will be impacted. But I think in terms of my data, when I broke down the proportion of people who took up cheap money, who had never seen expensive money in their life, it's not as much as people think. During the 2 years of, we'll call it funny money, because I don't think we're heading down there anytime soon, but 2 years of funny money, we had about 500,000 sales volumes occur each year, which represents about 1 million dwellings transacted on. 1 million dwellings are about 10% of the total dwellings in the country, which is about 10.4 million. So 10 million were people who transacted during the super low rates. But in that 10 million were subsets of buyers, investors who repeated, owner-occupiers who were shifting and knew this and changed and had low debt, and then obviously first-time buyers. So I would say that the cap is anywhere between 3 to 6%, Phil, based on the, I got cheap money, never thought it would go up, and oh my God, it's now very high. And 3 to 6%, whilst on spreadsheet terms and not incorporating that these are real families, real people, doesn't seem like a lot. The truth is it's still 300 to 600,000 households that could be in some pain. And it's just important to acknowledge that, the more the rates go up, the more pain will be felt. But yeah, that's a key thing to acknowledge.
Yeah. And I was looking of the bank's predictions, and I'll probably get this wrong because maybe I remember it incorrectly, but the CBA has pretty much said that's it, there's no more. I think NAB has come out saying there's probably 2 more rate rises this year. And there'll be cuts later on in 2024. So there still might be more pain ahead. Everyone's come out sort of questioning. We had the budget last Tuesday, whether or not increases to some of the support mechanisms for unemployed people is going to amplify ongoing inflation. It still needs to wash out, but it's not guaranteed there's not going to be any more rate rises for Australians, whether owner occupiers or investors. So as an investor, what do you do about it? Now, your thesis, Arjun, is that there is no such thing as a property sort of recovery. Well, there's no such thing as a property downturn because there never was one. You've run through some statistics around it. So what are the best investors doing right now to capitalize on this environment that you've discussed?
Yeah, the best investors are recognizing that, looking firstly long term, 90% of local government areas in Australia have achieved 5% compounding growth or more. And typically when financial planners, when wealth advisors are running their modeling, or even individuals are running modeling for themselves, probably using growth assumptions anywhere between 5 and 8%. Yeah. And so to know that 90%, and I'm including all the towns that you may love or hate, or somewhere that's small that you don't know, or if it work or not, they still were in that metric of 90% that grew. Yeah. So I think the first batch of successful investors are saying, I'm in this for that statistic right there. And as they transition to the second thought, I hope that they can use insights like this or articles like we've talked about, and even apply the same knowledge to COVID and say, when all of this was happening, there was still somewhere rising better during the boom versus somewhere else rising worse. And there was still somewhere well insulated during 2022 when interest rates were increasing versus somewhere that wasn't. And so using this data, I think the savvy investors will continue to just follow ticking boxes. Yeah. Do I have a buffer for my household? Do I have the borrowing capacity to buy the next? Do I have X% of my salary and or business that I save each month to grow my buffer? Do I have equity and savings left over outside of this risk management to buy property? Am I doing it for the next 25 to 30 years? And then finally, using today's information, where is the data going to be to put myself in that 1 out of 5 areas like we saw in Adelaide that actually declined, and I don't want to be there. I want to be in the 4 out of 5 that grew in Adelaide, for example. And so I think this is the key, what savvy investors are doing, mixing that long-term mindset combined with the short-term analytics to say something somewhere is just, how do I interpret this data better? Or how do I get the team around me to interpret this data better?
Well, this is no doubt, Arjun, one of the reasons why you and your business secured buyers agent there, because you're given these insights and this interpretation, and you're saying that the information is commoditized largely. It's what you choose to do about it is what's key, and you want to be buying in those areas which are showing positive growth rather than negative growth, and that's what the best investors are doing. It's having the sophistication to find out where they are before everyone else finds out, and that is certainly an art. Arjun, mate, you're always very generous with your time and your sort of insights and sentiments. So thank you so much for coming in and having a yarn to us today, mate.
I appreciate it, mate. And for all those tuning in, I hope you can take that data set to that deeper analysis and just go, hey, instead of, is this the right time or not the right time? A, is it my time? And if you are feeling good about that, great. Then second is get searching, get hunting, or get outsourcing, whichever it is to grow your wealth.
Whatever it is, yeah. And you've got heaps of info on your website, Arjun, if anyone wants to sort of read more about what you guys are up to.
Yeah, that particular blog, for anyone interested in the data we've run through today, it's investikit.com.au, and we've got a subsection called research. And those 3 research sections there have news and insights, which is insights like this, and it's called Australia's property downturn is not over because it never existed.
There you go. That's from Arjun Paliwal. Go and check it out. Arjun, thanks for your time. We'll see you again soon. Remember, there's heaps more info around this on smartpropertyinvestment.com.au. Go and check it out. Please keep those reviews coming wherever you choose to get your podcast. We are nearing, literally, it's got to happen over the next couple of weeks, Arjun, 10 million downloads of this podcast. So we'll have to have a party, I think, would be the appropriate thing to do. But keep sharing the information. What we're about is making sure you can make more informed investment decisions. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.